Thank you, Francois. Oh, I'm so sorry. Thank you so much. That was great. Wow. Presentation over. Any questions? Let's go home. Wow, we got the lunch. That's the important part, right? Thank you, everybody online as well. Hopefully, you're feeding yourselves and this doesn't ruin lunch. We're going to talk about investments. We're going to talk about taxes. We're going to talk about tariff. And we'll give you our outlook from our research partners. So we really appreciate all of you coming in today. And if you have any questions, everybody in the room, scribble them down, and everybody online, scribble them through the computer. We'll address them at the end. Because we're starting a little bit late, I appreciate your flexibility. The food came a little late today, so we got everybody fed here. That's most important. I want to remind everybody, we are accepting new clients. So in times like this, you probably know somebody who has some questions or concerns. And so please send them to your advisor here at A&I, and we would be happy to provide them the initial consultation free of charge. So maybe they're trying to buy a home, or maybe they're worried about taxes, or maybe they're worried about paying for a big expense like college or something along those lines. Anybody you know, as a service to you, we will provide that initial advice free of charge. Please take advantage of our second opinion service for all of your clients. And if you're online, you can scan that or just look at our website. Very good. So I've got a script because it is a really complicated time. It took some work to put the words together for this. We can go and be a little bit less scripted at the end, but I want to get through a couple of things because it is exceptionally complicated what's happening to America at the beginning of this calendar year. So Daniel Kahneman won his Nobel Prize in 2002 for his work in behavioral economics, which is a field that investigates how individuals make financial decisions. And a key finding in all of his studies was that people often act irrationally when making financial choices. Now, that may not be news to you. It's definitely not new to our team. But it is really hard to remain rational in an emotional time like this. Emotional reactions to market events are perfectly normal, however. Investors should expect to feel nervous when markets decline. It's the actions we take on these emotions that can be exceptionally expensive. And so one way to encourage rational decision making is to talk. That's what we're going to do today. We're just going to talk. So let's take a look at the market before we go too far, because it might not be nearly as bad as the news is that you're reading or seeing or hearing about. Global stock markets displayed wide dispersion of performance, across regions and styles over the first quarter of 2025. After making a new all-time high in the middle of February, the S&P 500 suffered its first 10% correction since 2023. That might feel like eons ago based on today's news cycle. Before it recovered and then ended the quarter down only 5%. Smaller cap companies, the Russell 2000, that are a little bit more volatile ended down 10% over the first quarter of this year. In contrast to the United States, many European and Asian markets rose sharply. Developed international stocks gained nearly 7%, driven in large part by a fiscal policy shift in Germany. Talk about them in a little bit. Emerging market stocks also fared well, finishing up the quarter at 3%. And most of those gains were driven by China, the country that apparently we've got a lot of worries about, which rose 15% in the first 3 months of the year. Interest rates experienced significant volatility throughout the first quarter, fluctuating amid shifting inflation expectations, the Federal Reserve announcements, broader market uncertainty. Overall, the 10-year Treasury rate declined from 4.57% to 4.3%. There were a lot of gyrations in between. That's not a big move. The decline benefited investment-grade bonds, however, which gained 2.8%. High-yield bonds ended in the positive territory, gaining 1% at the beginning of the year. This is not, outside of the headlines, abnormal. These returns, if you knew nothing else about the world, would be, okay, next slide, not undiversified. We're going to talk about what is different. So tariffs are a huge change from previous policy decisions made by the United States government. So give me 10 minutes to try and attempt to explain what's going on. We, being Capital Group, identified 4 motivations for tariffs and what they could mean for the investment environment. Decoupling, particularly moving America's economy away from depending on China. rebalancing, as in making things more fair, negotiating, and funding, as in probably bringing back a little bit more money into the U.S. Treasury. For instance, tariffs used for negotiating purposes are unlikely to persist, while those that are part of a larger decoupling process may remain persistent. The Capital Group base case is that the United States can weather changes to trade policies. Though higher tariffs would likely dampen economic activity and raise import prices, the U.S. has the advantages of size, economic resilience, and consumers with money to spend. Businesses have ramped up investments in the U.S., both domestically and abroad, from companies eager to maintain access to the world's largest economy. Capital Group is largely not worried about the tariffs. The fallout for other countries also remains uncertain, particularly those that rely heavily on the U.S. for trade, such as Mexico and Canada, where exports to the U.S. account for 20 to 25% of their gross domestic product. Yeah, they're a little more worried. For European countries, though, the GDP percentage that depends on America is closer to 3%. Stacey and I can attest, the three countries that we visited in Europe over the past couple of weeks, they were not largely worried. They're like, welcome to the club of crazy politics, America. We are likely to see looser macroeconomic policy to counter the negative effects. Germany, for example, has relaxed its fiscal policy for the first time since World War II. It's laid out plans to increase spending on infrastructure and defense, in part to reduce its dependence on reliance for exports. And that may be part of the reason why international stocks have risen this year. Here's a reason that we might be worried about tariffs, that tariffs might be an answer to a problem. It's certainly the problem that has been front and center from the new president. Over the last few decades, American manufacturing has declined in favor of lower cost manufacturing abroad. Free trade agreements benefit corporate profits via cheaper goods at the expense of the American worker, as manufacturing jobs moved overseas, mainly to China. In a trade barrier-free world, it makes sense for companies to move production to countries that have a comparative advantage to producing those goods. But an unfortunate side effect is that the loss of demand for these jobs domestically. So if you look at this chart, China joined the WTO in 2001. And what happened after then is the green line, which is manufacturing in America, didn't decline, but it flatlined. And the GDP continued to grow and consumer spending continued to grow. Americans got a lot of cheap goods and the company's profits went up, but the number of jobs that were in that sector did not increase. Labor's shrinking share of the global domestic product of the gross domestic product of this country is a significant loser after China joined the World Trade Organization. China's joining of the WTO illustrates an inflection point in corporate after-tax profits versus wage and salary distributions as a percentage of all the money that's made in the U.S. As globalization made it easy to substitute domestic workers for foreign, the wages U.S. corporations paid to labor in the manufacturing sector decreased as a percentage. This helps to illustrate labor's shrinking share of GDP. Trump and others in his administration view tariffs as a tool to make American manufacturing more competitive. And you can see on this slide that what was happening a long time ago, profits for companies were in the 6 to 8% range, and labor as a percentage was close to 50% of the gross domestic product. And what happened after that is labor declined to 42% or something like that, and profits went higher. Profits for American companies went between 10 and 12%. So the benefits of free trade were not dispersed among the people in America. That's one major reason. Another major reason, which for some of you in this room might be fairness. You might be thinking to yourself, well, it's just not fair because the rest of the world charges a much higher tariff on our products than we charge on theirs. There are certain industries of national security importance that should be reshored. I think both sides or all sides of this argument could agree that parts of the healthcare supply chain that depended on China made a national defense scare in our country during the pandemic. Maybe those things should be made somewhere closer to the U.S. Other things we can think of, maybe there's some energy or some defense. But the cost of producing low-cost retail goods would likely be too significant to realistically move back to the U.S. Tariffs are one tool to drive this return of manufacturing sectors, partially because every major trading partner in the U.S. has a tariff applied to U.S. goods that's higher than any tariff that's applied to our goods. And the Trump administration believes reciprocal tariffs are one way to enforce fair trade since U.S. exports face higher tariffs. So this slide, thank you to I'm Global Partner for making it easy. Made it easy for me to understand. We're down here in the bottom left corner, and everybody else is a much higher percentage somewhere to the right. Illustrative. At face value, the concept of trade reciprocity is simple, right? We charge you the same tariffs that you charge us. The Trump administration aims to rebalance, remember the four categories, rebalance tariffs between the U.S. and other countries to make them reciprocal. Such a move bucks the past 75 years of history. In fact, there's not a money manager alive who's ever managed money in an environment when the U.S. imposed tariffs of any size for any considerable length of time. So this is new. What happens when Wall Street sees something new? It sells right away and then takes its time to figure it out. And when it's figured out, it comes roaring back. This change in strategy is happening because the U.S. administration believes the balance has tipped too far as American industries face steep barriers to selling their products abroad. Take cars, for example. The EU imposes a 10% tariff on American cars, and America imposes a 2.5% tariff on theirs. It's unclear whether Trump's definition of tariffs includes the value-added tax that many countries, and most countries in Europe, impose on top of that tariff. In fact, so this slide is from March 25th. This is not right. So without compliance approval, I grabbed it from April 9th. And so this slide shows the reciprocity from the New York Times. You'll see that it's, of course, much higher now. That I think we're all aware that the U.S. is imposing a much larger tariff on China now, and China is also imposing a much larger tariff on us. They could invite retaliation, as you see on the screen, such as Canada's removal of U.S. liquor from its shelves. China could ban critical mineral exports to the U.S., decrease purchases of airplanes and agriculture, and increase investigations of U.S.-based companies with exposure to China. Now, this was written a few weeks ago, and I think all of those things have happened since this was written. So thank you to that company for predicting exactly what happened. What would normally happen over a long period of time has happened in days. And so this massive change that's going on, if it's happening quickly this way, it can happen quickly the other way. We can undo this as quickly as it was done. If there's one number to know about tariffs, it's the U.S. trade deficit. So this is something that the president and his team continually repeat. It hit 1.1 trillion in the calendar year 2024 as Americans bought imported products and a strong U.S. dollar weighed on our exports. The U.S. has run a trade deficit every year that I've been alive since the 1970s. Economists note that the trade deficit may be a sign of the U.S. economic strength, indicating consumers are buying, which would be a direct counter argument to everything that we've said. In fact, that would be the argument that has been made that if you went to college, regardless of what year you went to college, you were taught in college in your economics class. Unilateral free trade benefits everybody. And that is the big idea that's being challenged by the Trump administration today. It's a little bit like I've been living in a house with windows looking outside and wondering why it's cold. And then I reach over and realize there's no window there. It's a little bit like, I mean, it's just been so apparently perhaps obvious that we've missed it. Or on the other side of this argument, and there are the vast majority of economists who are still on the other side of the argument saying, no, Trump is a flat earther. The world really is round. And we've known this for centuries, and you're promoting something that we know cannot be true. And that's a huge philosophical debate that really is above our pay grade. Ours is to grow and protect your wealth and make sure that you can retire with independence and dignity. But that is what this is causing. That is causing that level of, really? Trump's novel use of emergency orders to implement or remove tariffs has unnerved markets. Prior administrations have used tariffs to varying degrees, but under laws that require detailed analysis, which allowed more time for companies and stakeholders to respond. Whatever the method, tariffs may represent a pivot. So we could be living through a time that's interesting and not boring. We'll talk about what offline perhaps that means for all of us. But the bottom line is that we do have a little bit of history of what this could mean for our portfolios right now, because it happened not long ago. In fact, in 2018, you may be experiencing a little deja vu because tariffs made headlines back then. The first Trump administration's tariffs on China sparked a trade war that whipsawed markets and dominated the news just like today. How did markets do? Well, at first they dropped 4%. That doesn't seem very big, and especially in comparison to what they did the year after, where the S&P grew over 30%. What did it do to inflation back then? It was moderate. Inflation was 1.5% in 2018, and it was 2.85% is the official number according to this document. And this one is from Capital Group. In the calendar year right after that, and then the world changed. The impact of the pandemic, wars in the Ukraine and the Middle East, the greatest inflation shock in decades happened shortly thereafter. How tariffs and federal spending declines will affect the world we live in now are really unknowable. So the lesson may be that in times like these, it's important to be clear about what we do and don't know, to be a little humble, and to be diverse. And I think our portfolios are benefiting from that. And talk to your financial advisor if you haven't seen that, because we're not down nearly as much as these headlines might make it out to be. But surely we're living in a world of uncertainty, and consumers are showing that. And so for my global partner, they're saying there's a big delta between how we're feeling about, well, things aren't so bad for me now, but I really expect things to be awful in the near future. Rising uncertainty among consumers and businesses act as a significant headwind to economic growth. And Global Partner is closely monitoring this to see if they need to go a little bit more defensive, in which case we will, and all of you will as well. Specifically, some soft data points is consumers' confidence. Consumers drive 70% of America's GDP, and that is what we need to pay attention to. Right now, current sentiment is holding up, but it's no surprise that it's weakened a little bit. It signals broad pessimism, perhaps, and that could perhaps lead to lower spending and more problems. What's the real problem for us, though? It's not this. You didn't know this probably or care about this. What you care about is inflation. Well, that's what I care about. And so what happened the last time we did this? Is inflation a problem? Is inflation going to come back because of tariffs? Well, the short answer is yes, but how it plays out is more complex. So take a look at the one-time tariff. Prices will likely increase modestly, but then even out over time. A more worrisome development would be a trade war that continues for a long time, where costs can't be offset. The retail sales, the automotive sales, all the news recently has been through the roof. Everybody tried to buy stuff and sell stuff and import stuff right before the tariffs hit. And so if that's a one-time hit, that's good in the short term. It'll slow down things in the very near future. But if it persists, that could be an ongoing problem. So take a look at what happened the last time this happened. Trump's decision to impose tariffs on imported washing machines, but not dryers, in 2018 is an often cited case study, because this is really fascinating. So if you're going to buy one, you're probably going to buy both, maybe, right? And it's a University of Chicago and the Federal Reserve study. The study found domestic U.S. manufacturers raised prices to match competitors despite not being tariffed. So the U.S. companies took advantage of the higher prices that the other companies from overseas had to charge and got more profits. Moreover, prices of dryers also increased, even though they weren't tariffed by anybody, as manufacturers may have used tariffs to raise prices opportunistically or split the increases between the washers and the dryers, right? And that's an often cited case study for the folks who still believe there's a window on the wall and that there's a flat earth, right? Or that this new idea is a really bad idea. The value of the US dollar also changed in reaction to tariff headlines. Higher tariffs generally lead to a stronger dollar, but the dollar has weakened since then. We'll talk about that in a little bit. If we do have a stronger dollar, that would offset a lot of the cost for these imports. All right, so there's the tariff official discussion. We'll talk offline what that means in a bit. Let's take a look at what this really means for our portfolios. Hopefully that gave you a couple of talking points and thinking points outside of the drama that you get from all of these sources on all the social media. That's the best I could do to make sense of the decisions that are being made. A diversified portfolio doesn't guarantee profits or provide assurances that investments won't decrease in value, but it does help lower risk. By spreading investments across a variety of asset classes, investors can buffer the effects of volatility on their portfolios. Overall returns won't reach the highest highs of any single investment, but they won't hit the lowest lows of any single investment either. For investors who want to avoid some stress of the downturns, diversification can help. And so what you see here are calendar years with little color boxes, and they're all blue, which is unfortunate, but that's the color scheme that the marketing person chose. And so when you see the dark blues, those would be the US large cap tech companies that have done well over the past 10 years. And so often, relative to all the other places you could have your money, that's what's done the best. But that's also caused them to be the most valuable today. And that's a risk because those are the stocks that, quite frankly, are declining a little bit faster, or in some cases dramatically faster, under the threat of tariffs. And so some of these other categories, year to date, if you drew this box, it would be international at the top. When you have a market downturn, it doesn't last as long as you might feel that it lasts. The S&P 500 typically dipped at least 10% every 18 months and 20% about every 6 years from the years 1954 to 2024. While past results are not predictive of results in future periods, each downturn has been followed by recovery and over time a new market high. We're somewhere between the 10 and 15 today. It happens more often than you think, about every 3 years. And it takes on average somewhere between 135 and 256 days for the market to recover, as in way less than a year, about 6 months to 9 months. On average, that's been the history we're in. And again, like I was saying at the beginning of the presentation, if you only saw the year-to-date returns, this wouldn't be a big deal. It's all of the tariff talk and this radical idea that is completely different from what all of the money managers today were brought up being taught was the gospel. And so what do when they see something that's that new? They sell. They sell. So, but the decline that they've sold has not been any greater than any decline in the past so far. In fact, the average return for the past 10 years is pretty doggone good. It's well above your average. It's been, according to Capital Group, about 13% per year, and the long-term average has been 10%. So it's always important to maintain a long-term perspective, regardless of what stage of life you're in, especially when markets are declining. Though stocks rise and fall in the short term, I think you're going to live longer than 256 days. In fact, I'm going to hazard a guess you're going to live more than 10 years. Even including the downturns, the S&P 500's annual returns is really good. Is really good. So it's natural. It's natural for our emotions to bubble up, right? During periods of volatility, those investors that can tune out the news and find something they can control will do better, both financially and emotionally, right? All right, so buying shares when the stock prices are down, our investment companies are doing that right now. They're taking advantage of it. In fact, every company that we've spoken to says this is a short-term problem, and the long-term problem will work its way out. Creating and adhering to a thoughtfully constructed investment plan is another way to avoid making short-sighted investment decisions, particularly when they move lower, because you've got opportunities to buy companies that you liked before that are now at prices that are really attractive to you. So don't be surprised that some of the famous investment managers come out in a few months when they have to report what they bought right now, and you'll find out, oh my gosh, famous investment manager who's on the news all the time from Omaha, Nebraska, had went and bought a company I actually heard of when the price was really low. Retirement plans, if you're in one of those and you're still contributing, are one of the best ways to do this without thinking about it, because you're just making ongoing contributions to that. So if you have other money, consider that as an option too. With many of our clients who are bringing dollars in today, we're spreading it out over a few weeks' time or a few months' time. We're not trying to say this is the absolute lowest low or the absolute highest high, just being a little bit humble and saying, in times of volatility, there will be a good time to buy, and we'll only know it in hindsight. Missing just a few days in the market is something that's knowable, and we can control that. Every S&P decline of 15% or more from 1929 to 2024 has been followed by a recovery, and the average return in the first year after this recovery was 52%. Even missing out on just a few trading days can take a toll. So a hypothetical investment of $1,000 in the S&P made in 2014, this is very recent history, we've all lived through the chaos since 2014, would have grown to 2,869 by the end of 2024. That's a lot of money. But if you missed just the 10 best trading days during the period, you would have ended up with just $1,500 or 45% less. And that's an expensive mistake. And we just never know when those days are going to happen. In fact, I didn't put that slide in, but there will be facts that show you that the best days often happen during the worst periods of time. Over the past couple of weeks, just anecdotally, 2 weeks ago was terrible. Last week was incredible. If we hadn't had the week before, we would have said, this week is great. This is a great market. They often happen on the heels of the worst, when we're feeling the worst. And just so you are reminded again, international is working. And you have that likely if you're in one of our standard portfolios and invested just like I am, your international portion of your portfolio has really paid off recently. While we're seeing headwinds in the US, we're getting some good news in other parts of the world. European stocks have been a bright spot this year, significantly outperforming US stocks by the most they've done in 40 years. So it's not just a little bit of a gain, it's a huge difference between the rest of the world and the US. While we're in Europe, people are saying, well, what do you think about American politics? And we said, very little, because we're here. That's why we're on vacation. And they said, and we asked them, and they said, we're not thinking about it either. We've got our own crazy politics to worry about. Fiscal stimulus, particularly from Europe's largest economies in Germany and France, increased defense spending, accommodative monetary policy could stimulate economic activity and boost markets. And just so you know, just because they've gone up doesn't mean they're expensive. They're still inexpensive compared to. So the bars that you see here, when that little dot is below the box that you see, that means that it's cheap. And when it's above, it means it's really expensive. So going from left to right, global equities, big companies are really expensive. United States is even more expensive than that. Developed international is right in the middle. This is Europe. Eurozone is right in the middle. United Kingdom is a little cheaper than that. Japan is a little bit higher. It's done well recently. Emerging markets is average and China is super cheap. In fact, the last quarter, it was cheaper than that. So it's still inexpensive, even though they're outperforming by so much this year. And finally, the weaker dollar. So the dollar is the biggest market in the world, and it is the most liquid investment that you could make. And all sorts of commentary now. During my entire career, it's always been, when will the U.S. lose its, dollar safety? When will the reserve currency? Blah, 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 blah. Well, becoming weaker is good for investors. So if you, especially portfolio managers like you're with, who have a little bit internationally, and you'll see that the dollar has declined dramatically during your lifetime, and you might not have even noticed it because in the 1980s, you maybe didn't have as much money as you have today. You probably didn't have near as much. And during that period of time, international stocks grew a lot faster than American stocks, 404% compared to 300%. And then when the dollar strengthened, the international looked less competitive. And this is a period of time that now the dollar is declining. And it's declined by like 3%. And it's making big waves. And it's not that much. It's not that much compared to how much it's declined in the past during periods of very good times, very good economic times for America during the 80s and 90s. And still the dollar was declining during those periods of time. So maybe that's something that you can set on the side and say, yeah, but history shows for my family's portfolio, it's okay. It's okay. Treasury yields remain elevated. This is a challenge for people who are borrowing money, but it's not a challenge for retirees because we're beneficiaries of that. This is the 10-year US Treasury. It's in that 4% something range, and things are bouncing around. But our bond positioning in our portfolios look really good. In fact, if you looked at the orange dot, that would be the Vanguard, just everything bond. But what you'll see with the holdings that are in most of our portfolios, or a large number of portfolios, is that the yield is a little higher, the dots are a little bit higher, and their risk is lower to the left. So that's a good position to be in. If you've got bonds, you're getting a pretty good yield right now. In fact, these are the yields as of the 31st of March. That's a good set of numbers there for a good number of the holdings that you have in your foundation income portfolio at A&I. Fives and sixes are great. And when you start a period of investing with good yields, you tend to have really good yields. And so this is a slide I've put up in the past too. We're right in that range of that orange dot. And the higher your starting yield is, the better your yield will be over the next 5 years. So if you're getting a 5% today, that's really good because in the very recent past, you were getting like 2% or something on bonds, right? So it's a good time to be a bond investor. It's a hard time to be a mortgage borrower, and a good time be retiree or anybody else who wants fixed income. Like Ann Walsh said, He's the CEO of one of our largest bond fund managers, Guggenheim Investments. With so much policy uncertainty, we are maintaining an allocation to defensive, higher quality positions that can provide liquidity should market volatility escalate further. We're glad to have smart people like her on our side. I could have put face and name from a number of other companies who we've spoken with on our Zoom calls and our investment policy committee year to date, and they would have said something pretty similar. Finally, managed futures, you might have a little bit of this in your portfolio. Year to date hasn't been great, but it does really well during times when things really are challenging, like the great financial crisis, the first set of bars. It's the big blue one that was over 13% during that crisis. During the COVID crisis in March, at least it was flat. It didn't decline. And then during the interest rate, massive interest rate increase of 2022, during those years, it did even better in that period of time. So if you want to learn a little bit more about what we call SIMBA, secular bear market allocation, and alternative investments, it will dampen your portfolio, and it may be a good time to do that. All right, so the final slide, Athena Invest. Like all of you probably know, because many of you, everybody in the room is familiar to me at least, and online, I probably know quite a few of you too, and say hi to me if you don't. What I love about Athena is they make the big complicated things simple, and so this is the way they look at it. They lock up all the stuff that's in the world, and they boil it down to 4 big categories, and they say the first one is behavioral. And investors right now are good, even though the news is bad, the news is bad, the news is bad. As of April 11th, behavioral economics, this is their, the Athena patented process of measuring this, as things are good. The second category is economic, and that's normal, even though it might feel like things are crazy. The news for what has happened so far is good, both goods and services that America produces to get to that GDP number that we started with at the beginning are normal. If you only saw that and you only saw the market and you didn't read the headlines or get bombarded with the negative Nellies that are out there, you might feel like this is no big deal. The third category has been read for a long time, and that's the valuation category. And that's because US equities have grown so much, been the envy of the world for years now. And so when they grow a lot, their valuation gets expensive. And so that's a warning sign. But we got a green, we got a yellow, we got a red. And the last one, technical indicators are again normal. Caution to normal. So all in all, if you look at this and you look at your equity portfolio, you say, it's not bad, right? The news might be terrifying. It might be energizing to think that America is finally going to be getting back at the world and making things more fair, or it might be aggrandizing to all of your other emotions to even think about the current administration, depending on where you're coming into the situation. But like the most beautiful and wise person I know told me this morning, my wife said, don't borrow anybody else's trouble. Right? This is not our problem. Don't borrow trouble. We don't need to solve the dollar. We don't need to solve the trade war. We don't need if certain politician is causing us stress. We can tune them out. We don't need that. We can choose not to pay attention to what's hurting us. We can go a different direction and feel better because underlying companies are doing just fine and our investments are doing just fine. And they're weathering this much better than the news would have you believe. So on this wheel of emotion, it feels best when the highs are high and we can invest more. And it's surprising to us when things do well, when things feel bad. But often that's the best time to be invested is down at the bottom or declining. And we'll never know the exact bottom, right? It's always feeling like it's always going to decline because that's this market recency bias that we have. Those are often the times where talking to us and doing very little to nothing or letting the money manager find great opportunities out there to get us back up better than we ever were before. So that is the final slide. I really appreciate you paying attention. Invite your friends and family to listen to us. That's the end of my prepared commentary, but we've got, question and answer and my very wise certified financial planning partner, Francois, will we'll navigate that. So thank you so much for listening to me, trying to make sense of the world we're living in right now.